Hello, everyone. Welcome back to another edition of Signal or Noise. This is episode 34. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, this is what we're going to be discussing today. We got four things on the docket. Number one, the easy money has been made. This is a saying we hear all the time in markets. I want to go back in time and look at a quote from a famous investor who said this 7 years ago, and just look at what's transpired since then. Number two, the market finds a way. We're getting a ton of questions, less than 2 months away from the election. Tons of questions. Well, what happens if Trump wins? What happens if Harris wins? People are nervous on both sides. So we're going to talk you through that. Number three, who's going to carry the boats? And if you don't know who said that, we're going to tell you who said that. And we got a big conference coming up for Creative Planning Connect. And we're going to dig into this quote, what it means and how you can apply it to your life. And then we'll end, as we always do, with Signal or Noise. The yield curve, Peter, is back, and it's back to positive territory, ending the longest streak in history for inversion. I want to take a look back and see what happened the last few times it flipped back to positive after a long period of inversion. Okay, the easy money has been made, and we hear this every year. If you Google, the easy money has been made, 2009, 2010, 2011. Every year there's been a different article or someone along the way is saying this at some point during the year. This is a quote from the great Howard Marks. Love his memos. Read them all. Back from July 2017, so 7 years ago, this is what he wrote. Finally, while my observations are uncertain and should be taken with a grain of salt, what I am sure of is that valuations and markets are elevated and the easy money in this cycle has been made. Howard Marks, Oaktree Capital, July 2017. What's your reaction?
So I'm a Howard Marks fan because I love, like you, reading his letters. But his predictions, twofold here. Number one, his predictions have always been off or meaningless. Like a lot, I don't know anyone that says cautiously defensive or cautiously optimistic or very tentative positioning. But many, many times he said things like this: the easy money has been made, and he has almost always been wrong, as he was here, like completely wrong in his prediction. I think if you read the letters, but continue on an investing course, ignoring the general directive advice he gives, you'd be better off.
Yeah, for sure. And this is he's a credit manager first and foremost. And as we
Right.
know in the equity markets, much harder to make any type of prediction because you not only have to predict what's going to happen with earnings and other things, you have to predict where valuations are going to be in the future. So, yes, were valuations above average in 2017? No question, as I'll show you in a little bit. But today, they're even higher, which was not obviously one of his expectations. But I want to attack this notion, this concept of easy money, and the idea that it's sometimes it's really easy for investors and other times it's more difficult. In my view, there's always risk, even if you can't see it. And if we look at the last 7 years here, I'm showing you July 2017 to July 2024. It looks somewhat easy in terms of S&P's up 152%, 14% annualized, Peter. So well above the historical average of around 10%. And if we look very closely and we dig in here, what we'll find is it wasn't that easy. So he was right in respect to it wasn't a straight line higher. It almost never is. But we
Well,
had
yeah,
three.
it never is. I think what he meant was the bigger returns are behind us.
Correct.
Let's just do nothing and get big returns. Yeah, it was volatile, but definitely still easy in the sense that much higher returns than expected or than historical norms.
14%, right, versus
Yeah.
10% historically. And I just want to highlight here a few of the instances that were pretty difficult over this period. Of course, 2018, we had that 20% bear market. 2020, the COVID crash, 35% fastest bear market in history. And then, of course, 2022 with inflation, Fed tightening, 27.5% on the S&P 500. So it wasn't easy. We had three bear markets in 4 years. So he was right about that. The part that he was wrong about was that the market would be this resilient and come back.
Right. And I think that, again, bear markets, as you know, probably better than anybody, they happen every 4 or 5 years anyways. You make a prediction. Yeah, we got a couple of them in there. I would call these pretty benign bear markets, though, even because a typical bear market, think of '08, 9/11, the tech bubble, it takes half a year or multiple years to recover from. These bear markets were snap markets like COVID, and then everything's better. You get the full recovery in just a matter of months, or the tariff war, and you get a full recovery in a matter of weeks. And most people didn't even see the bear market by the time they got their quarterly statement. So I mean, look, what an epic period of time to be invested in equities, and look, Howard Marks is one of the greatest credit investors of all time, and was dead wrong about this. Just another example that focus on your long term goals, hold equities for the long run, credit for the short run, and ignore the noise, ignore the predictions.
Yeah, he's a risk manager first and foremost,
Right.
as he'll tell you, and so he's always identifying risks. And certainly, there was a risk 7 years ago that things were elevated, markets were hitting all-time highs. 2017 was a year where the market was just running like crazy every single month. Higher valuations were considered to be high, and like you said, that was expected to mean revert. It didn't happen. Now here's the question here, Peter. Fast forward to today. We could kind of make a similar statement, right? So what he didn't anticipate, I think the CAPE ratio back in 2017 was a little bit under 30. I think it was around 29. Today, 35. And with the exception of 2021 and the tech bubble in 2000, it's the highest valuations we've seen for US equities in history. So has the easy money been made? Should he say it again now, or should someone say it again, and maybe they'll be right this time?
Well, we've gone a long time without a bear market, haven't we? I mean, so look, it's
You're
easy to
defining the
say.
bear market. You're saying it without a painful, punishing bear market,
Right,
right?
right, right. And
Okay.
I think even without a painful correction, it's been quite a while. So I think it's not. I think it's a pretty safe bet to say we're probably going to have one in the year or two. But I think if you zoom out, as you always do with your charts, they always look very different when you zoom out. The best recipe is just to invest and move on, invest and move on. Don't try to outsmart the market. It's hard to know what to overlay on these charts, the money supply, interest rate. I mean, there's all kinds of things that are different about any given period of time that make it just too versatile, too dynamic to make a short-term prediction.
Right. We can't predict where this CAPE ratio is going to be essentially 7 years from now. That's the challenge. If it's the same, then we're just talking about what's the earnings growth, right, for the market. If it's higher, okay, we're going to have above average returns. If it's lower, the odds seem to favor that, then we'll have below average returns, but we don't know where this is going to end up, which makes predicting the future impossible. Now, here's my take in terms of investor expectations and concepts of easy money. I wouldn't be looking at the S&P 500. I would be narrowing in on the Nasdaq 100. And I just want to show you this table here, Peter, because it's pretty remarkable. We're currently in the fifth longest streak in history for the Nasdaq 100 above its 200-day moving average. And if we look at number one, number two, and number three, and we include this current period, 4 out of the top 5 have been in the last 11 years, since the beginning of 2013. So an unbelievably smooth ride higher for many long periods over the last 11 years for these biggest companies, for the biggest tech companies that we're talking about. And we're talking about returns for companies like Apple and Amazon 1,000%, right? And so what I want to drill home to investors is this: we're living in the outlier period in terms of big cap tech and in terms of NASDAQ 100. This is the thing I think most likely is not likely to repeat in the next 10 years, unless you're thinking Apple's going to be the size of the US economy. Another 1,000%
Well,
return.
I mean,
That's what you're talking about.
or there's the next Apple. It was, look at Nvidia, right? It was
Yep.
there, and then it became the next big thing. There could just be five other companies that take that mantle. But generally, I definitely agree that, and we saw very recently how quick these large cap tech stocks can contract
Yep.
as when their PE ratio contracts. And so I think that day is probably a coming, but we've been saying that for a long, long, long time.
Very true. So what I'm saying, last 7 years, Nasdaq 100, 20% per year. That fundamentally would be very hard to replicate in terms of earnings growth and extremely hard to expect valuations for these companies, which are already high, to be higher 10 years from now. So if I had to guess, and I'll look back and I'll grade myself 7 years from now, the next 7 years for the NASDAQ 100 and big tech are going to be much more difficult, which comes back to that point we've been making all year: diversification, diversification, diversification. Fed is set to cut interest rates today, Peter. Maybe we're at the start of a sea change where smaller companies, where value companies start to do better. We know smaller companies have been hit hard by higher interest rates. Perhaps there's going to be a shift. And if there is a shift, you're going to want things other than just the big tech leaders in your portfolio. Is that a prudent way to look at this without making a prediction?
100%, 100%. And
Okay,
you know, like,
let's
look, you
yeah.
own the S&P 500, you're overloaded with tech already. It's very hard as an investor today not to be exposed to a very, very healthy amount in this space.
Awesome. Okay. So if you're thinking about your portfolio, you want to make sure you're diversified for the next 7 years, the next 10 years, and longer. Reach out to us, creativeplanning.com/Charlie. Schedule a call or a meeting with an advisor. We're going to give you a free wealth path analysis. And with that, we're going to look through your portfolio, give you a retirement roadmap. Are you on the right path? And give you proactive tax strategies. Creativeplanning.com/Charlie. We're in all 50 states. So we likely have a location right near you, and we have over 300 billion in assets under management and advisement. We're here to help. Creativeplanning.com/Charlie. All right, number two, the market finds a way. You put out this tweet, regardless of what's happening in the world or who happens to be the president, the market finds a way forward. And I'm just going to drill down on this chart because it shows you the S&P 500 since 1970, 10.8% return annualized. And what you're looking at here is all the difficult times that should have been reasons for investors to sell. And many times they were in the short run, but the market has found a way higher. Talk me through this chart and how investors should think about this.
I mean, I love this chart. I mean, it really, and I couldn't find the source of it, but it's incredible at illustrating um, all of the different things that happen. So if you pull out on zoom into any one of these things, and you start to go through the narrative, the hysteria that was in the media around any one of these headlines, and you do see there is some market impact, but you get a sense of how these are very temporary pullbacks on the inevitable climb up the mountain. It really, I mean, this is a chart that if you were trying to teach, behavioral economics to an investor, this is the chart I'd want them to have plastered above their computer on right next to them when they're sitting at their desk, so that every day they come in and see, no matter what I'm going to read today, no matter what I'm going to see, imagine that on this chart and where the market goes from there. Because at the end of the day, prices historically have gone up. Earnings, a company that earnings even go up things are going to cost more 10 years from now than they cost today for almost every single thing that you're doing. It doesn't care who's the president. It doesn't care about terrorist events. All of these things matter a little bit day to day, but in the long run, it really isn't going to affect the price of a burrito bowl at Chipotle 10 years from now. And if you can just get the brain around that concept, like, look, I'm going to go buy a value meal at McDonald's 10 years from now. Do I think it's going to cost more? Do I think there are still going to be restaurants and places doing well? If the answer to those things are yes, probably okay to be an investor over the long run. But you got to ignore the day-to-day headlines. I think this chart is, one of the best I've seen at illustrating that.
Yeah, 100%. There's going to be more of these. We don't know what it's going to be that takes the market down. It's always a different reason. You and I have covered on the show many of these in recent years. Silicon Valley Bank, the attack on Israel, and so on and so forth. Has been
Right.
more and more and more. And the big one, of course, that's coming up is the election. Of course, people are not looking back at history when Biden was elected, Trump was elected, and before that, when Obama was elected, and what the market's done since then, up and up and up and up and up. They're worried about this election. They're worried about Harris or Trump. And this is a headline I just saw this morning. You always get these, and this is really for investors. It's tough to see headlines like this because you see a famous investor like John Paulson, hedge fund manager, says he's going to yank his money from the market if Kamala Harris wins the election.
I think these are interesting headlines because you're hearing more and more people say that they will do that. I think this is different than other elections in the sense that, sometimes people would say, well, if Trump wins or if Obama wins or if Biden wins, I'm going to leave the market. And that never
Or
made
leave
sense.
the country, right?
Yeah, or leave the country. And that doesn't make a lot of sense as an investor. We both know, and anyone that listens to us regularly knows it doesn't matter who's the president. But I think what people are saying now is the tax policy that's being proposed will drive people away from the market. So I'm going to leave the market early if I see that happening. I think that's what John Paulson's saying. I don't think he's commenting on everything that these presidential candidates are
Yeah.
about. He's just saying, look, if people are going to see their capital gains taxed, even if they don't sell, and if the capital gains rate is really going to match the ordinary income tax rate for people, that will drive a lot of people out of the market. So I won't want to be in the market. And I think that's the comment that we're seeing not just Paulson, but many others make.
So let's talk about those two aspects. Number one, corporate taxes. Right? We got that big corporate tax cut under Trump. That definitely boosted earnings. There's no question. If you look at the net profit margins, they went up a few percent. That was another thing, I guess, maybe Howard Marks didn't anticipate the impact of
Yep.
that. It had a real impact. So the question is, if we reverse it, and originally the plan was actually higher than this, but now Harris is saying maybe we only bump it up to 28% from currently 21%. And you have different analysis in terms of, well, how much of a hit that's going to be to earnings. We know it will be a hit. The problem, of course, is A, we don't know if what the policy is actually going to be. B, we don't know if it's going to pass. So if we have Republican control of the Senate, which seems to be the projection, then you have a split. They're not going to vote for this, right? Nothing gets passed like this. And also, we don't know everything else that's going to happen. So it's not just tax rates, obviously, in isolation. There's other factors as well that go into markets. But no question, I think all else equal, obviously higher corporate tax rates, worse for the market. But is it enough for an investor to say, I should sell now to front run that? For me, if you're at 10 years, 20 years, you're investing for it's not enough in terms of the impact to earnings.
No, 100% no. No one should exit the market based on single digit tax rate changes. That's not enough to change investor behavior. Now, I do think the other proposals around unrealized capital gains could be detrimental, but I think the probability that that's actually going to happen is, probably less than 5%.
That'll be a tough bet. Okay, so how about capital gains in general? They're talking about raising it now from around 23% to 33% for tax for the highest. The net investment income tax, they're going to bump up to 5% if Harris wins, and the top rate would be 33%, which would be the highest rate we've seen since 1978. So,
Yeah, you got to
and I
remember
don't know when this would take effect. Maybe it wouldn't take effect until 2025. That's another element in terms of the timing, how long it would be before this. But if someone has a big capital gain, should they think about
Oh,
selling part of it today?
absolutely. Yes. So if you get a Democrat president in Congress, the proposal is, like you said, to increase the highest capital gains rate to 33%. Obviously, if you live in New York or California, you're now paying 45 to 46%, right? So it's a very
Yeah.
significant change from where we are today, which is 20% plus if you live in a state with taxes, adding that. So there's no question that if you're somebody that and you've got something if you've got a piece of real estate or you've got a big position in Apple stock and you want to sell it as part of your plan, you want to sell it at some point, but you're contemplating when to sell it. This would be the new piece of information that would cause you to sell between election day and December 31st, because why in the world would you wait to go to next year and pay, 60% more in taxes? No one's going to do that. So I do think that if we see, because this policy impacts capital gains so significantly, I do think if we see this happen, we will see a lot of movement. Now, that doesn't mean won't be a false start. When there was a point recently where there was a very high probability the capital gains rate was going to go up after Biden was elected. He made promises around it. So did Congress,
Yep.
and you saw massive selling. I mean, real estate, business owners, equity, everything else, and then it didn't happen, right? And so but I do think this is such a significant change. We will see. I mean, if I was sitting with a client and they go, "Hey, I've got this thing and it's up $100,000, or if it's $2 million, and I want to sell it sometime in the next couple of years," I'd say, "Well, let's sell it before the end of the year because we know the capital gains rate is 20%. And we know next year, if we have, of course, if we know the election outcome, we know there's a high probability it's going to be much higher next year. Of course, the logical investor in that real estate or business or stock is going to sell before the year is up.
Yeah. So the question, I guess, would be then if everyone's front running and trying to do that at the same time, how much of is it going to cause a big decline in the markets? No one knows, right? Because there's
Yeah,
so much uncertainty, right, around the other
right.
stuff.
Yeah, that's right.
So yeah,
And I
it's going
don't
to
think
be
enough. I don't think enough to rattle markets because I think the vast majority of people, their hold period is far, far more than 5 years, even, right? They're holding for 10 years, 20 years, or their life.
or
And
life,
so,
right? So
yeah,
and we haven't talked about, so if you're not planning on ever selling that, then you get the stepped up basis when you die for your heirs. Well, then you're not paying any tax on that
correct.
capital gain, assuming you're
Right.
under the estate tax limit.
Yeah, like at
So
creative planning, 99% of our clients, their response would be to shrug their shoulders and do nothing, right? It's a very, very long-term plan that is going to follow through no matter where capital gains rates, income tax rates, and estate tax rates are up, down, sideways. It's not really impacting the plan. But for somebody who's motivated to sell a concentrated position or a property, of course, it's going to impact their behavior.
okay, so in terms of the president, doesn't matter. So we're getting questions from clients every day. There's a few charts that I like to send advisors to kind of talk them through, just in terms of odds and probabilities, right? The market can always go down under any president. We're not certainly not saying that, but you had this great chart in your book breaking down all the elections historically and just looking at the average returns under different scenarios, right? Republican president, Republican sweep, Democrat president, Democrat sweep, all different combinations. And what I want people to focus on here is that end 48-month period, looking at everything's higher, and there's a range of only about 11%, from 38% at the low end, 49% on the high end. So your expectation, just based on the odds, is the market's going to be higher regardless of who's in control. So obviously, we can't predict right now how that's going to shake out. There's going to be a lot of rhetoric, on both sides saying, one is better or one is worse from the market, but historically, just on average, that really hasn't been the case, right?
Yeah, it doesn't matter who's president, who's in Congress. Everything's up and to the right. Fasten your seatbelt, turn off your TV. Everything historically has worked out very well, regardless.
Yes, and my overall point in terms of the U.S. system is, thank goodness that's the case. Thank goodness that who the president is doesn't have an enormous impact on the stock market, because that would mean they have absolute control, for better or for worse. And the risk, of course, is they do something that's really bad for the economy or the
Right.
stock market, and they simply don't have enough power to do that. They need a clean sweep. They need a super majority to get anything enormous passed. And if that's not good for the stock market, it's not good for the economy. Guess what? They're going to be out in 4 years. So keep in mind, the number one goal of most politicians, Peter, right, is to get reelected, to come back in power. So they're cognizant of that as well. And we're seeing that even with Harris and Trump, like walking back a lot of positions and trying to cater to both sides, and lowering tax rates where they need to, or doing other things wherever they need to try to get reelected. So thank goodness it's not the situation of somewhere like China, is what I always say. There, who the leader is can have an enormous impact. Thank goodness that's not the case in the United States.
100%. Yeah, it's very reassuring that despite all the rhetoric, whether it's a Republican or a Democrat, they don't have total command of the markets, and you see
And
that
here's,
in this chart here too. I love this chart
yeah,
in terms of really
1960,
showing the periods.
you got every president here. And yeah, there's been presidencies where the market's been down. We see Bush, the timing of the financial crisis took it down, and he had the dot-com bubble during that period as well. But since then, right, we were talking about the election in 2008, 2012, 2016, 2020. market's been strong all of those periods, and there was the same concern, same worry. Of course, at some point there's going to be a down 4 years, but if you have 10, 20, 30 years, you should not be thinking about who's president and making any
Right.
wholesale changes in your portfolio. And if you're partisan, and we seem to have more of that these days, don't let that impact your portfolio, because if you only invest during a Republican administration or only invest during a Democrat administration since the early 1960s, you can see the difference here versus staying invested. $10,000 grows to 100,000 only in a Republican, 500,000 only in a Democrat administration, and over 5 million if you stay invested regardless. I mean, that's kind of a stunning differential there.
Yeah. Yeah. Incredible. Every chart reaffirms the same position we've espoused for years, which is market's not blue or red, it's green, right? Only cares about money.
Absolutely. So as long as a president, Congress, the Senate, as long as they're not doing something that's going to impair long-term earnings, it shouldn't have a huge impact about where the market's going to be 10, 20, 30 years from now. Okay. Who's going to carry the boats, Peter? Love this saying. And you and I know where it came from. David Goggins got this big Connect conference coming up for all creative planning clients, employees. A lot of thousands of people are going to be going to Kansas, going to be getting me out of New York and into Kansas once again. I loved it last year. Tell me about a little bit about this year's agenda, why you put all these different topics together. It's not very much not just investing and financial planning. It's really a wide range of interesting topics. I learned a ton last year. I'm excited for this year as well.
I love this event. It's just an incredibly exhilarating event. It's also virtual this year, so we've got thousands of clients joining virtually, which will be cool. But we try to cover the gamut on finance and economics. A lot of top speakers. We'll have Jeremy Siegel and many others, coming to speak at this event. But then obviously, it's just a wealth and health event always, and so we have a lot of things around quality of life. This year, we've got Dr. Joseph Coughlin talking about longevity. We've got David Goggins talking about overcoming adversity. A lot of people are very excited about that. And then we always have a political element, because there's no question that the worldview of the United States impacts the global economy. So in the past, we've had President Bush and Colin Powell and Van Jones and so on. And this year, we've got Bob Gates, former director of the CIA, and very interesting person, serve under both Democrats and Republicans. So between him and Goggins and all of the health and finance stuff, it's going to be an incredible event. Which one are you looking forward to the most?
I highlighted it there. I gave it away.
David Goggins. All right, that's your
Definitely
guy. All
David
right.
Goggins. Big fan. Read both of his books, and just love the message. Right, and the message is, he was a Navy SEAL. You go through this training, buds. Everyone knows how difficult it is. Most people fail. Most people ring that bell, and they have this hell week there, where it's just absolutely insane what they ask these guys to do, and they have to carry these boats that are hundreds of pounds, for 24 hours or longer, and people are dropping out, and he just starts yelling out, "Who's going to carry the boats?" Essentially saying, I'm gonna step up. Like, who's with me? Who's gonna stay in the game? Motivating everyone. I think it just really transcends kind of the military. It transcends into the workplace, your everyday life. Whenever I need motivation, I'll just go to his X feed and watch a clip of him, doing something physical, doing something that seems ridiculous or impossible, and it motivates me to do something as well. But from a leadership standpoint, Peter, how important is this concept in terms of setting the example for the company, in terms of who's going to carry the boats? You're going to step up whenever something needs to get done. You're going to lead by example.
Yeah, I think the leaders at Creative Planning definitely embody that spirit. I mean, they're never asking anybody to do something that they're not doing day in and day out. My kids are so excited about David Goggins. I think that might be the favorite speaker they've ever seen show up at a creative planning event of everyone we've ever had. And I think a lot of our team here, his name immediately jumped out in the program. So it's going to be really cool to see him in person. I know a lot of people are really excited about him, and it's his ability to mentor from afar. There's so many people that cite him as having had a major impact on their lives that obviously he hasn't met. And you see very few personalities that really transcend like that. So it's going to be neat to see him live.
Yeah, awesome. And if you haven't read his book, Can't Hurt Me, the first book, definitely
Great book.
check that out. Unbelievable, the story that he talks about. Very difficult childhood upbringing, overcame that, and then just really it's a mental game, and he's just keeps pushing. He doesn't let anything get in his way, and like I said, it's just inspiring and motivational for everyone to kind of have that mentality. And it's easy to make excuses, but if you listen to him, you said let's just stop with the excuses and get it done. And it's just, if you haven't listened to his podcast with Joe Rogan, I think he did more than one. Definitely check that out as well. Very raw, very emotional, but inspiring message.
Yeah. Amazing.
Okay. Signal or noise, Peter. And the yield curve is back, one of our favorites here. We've talked about the yield curve a few times on the show, but we got a different signal here than the inversion. And what we were saying previously with the inversion is there's a long lag between the inversion and when a recession typically begins. There's really no relationship between the inverted yield curve and the stock market. So very hard to predict what the stock market's going to do. But here we have something very interesting. The yield curve is no longer inverted if we're looking at the spread between the 10-year and 2-year. So the 2-year yield had been higher than the 10-year for the longest period in history, over 2 years, since July 2022. And now it's flipped back into positive territory, meaning that 10-year yield is back above the 2-year, which is normal. You would expect longer term yields to demand a higher interest rate because you're locking your money up for longer. That's a normal situation. But if you look back in history, and I'm noting here on the chart, when these things flip back into positive territory, what has that meant for the economy? We get some interesting results, and I'm just going to run through the last 5 here. March 2007, recession begins 10 months later. December 2000, recession begins 4 months later. June 1989, recession begins 13 months later. October 1981, a recession began 2 months earlier. And then May 1980, 3 months earlier. So is this time different, Peter? Or are we setting up to see economic weakness ahead? 5 for 5 in terms of the last 5 periods. We saw a long inversion coming out. We're flipping up into positive territory.
It's hard to ignore this one, right? But I think that the thing about recessions is some of them, were they going to happen anyway? Like 13 months later, right? I mean, were they going to happen anyway? And there's a very big difference between a mild recession. We don't even know we're in a recession. And then afterwards, the government tells us we were in a recession versus a real hard recession. And so I'm going mostly noise, a little bit of signal, but mostly noise. I'm very curious your thoughts here.
Yeah, it's hard. You combine this one with the one we talked about maybe a month or two ago with the unemployment rate rising off a low, and this much off of a low, and we've seen a recession every time. This time really has to be different, and it is a little bit different. And I'm going to show you the chart that for me makes it pretty difficult here and now to be in a recession. And that would be, we're spending money, Peter, like crazy in terms of the federal government, $2 trillion deficit. In the last 4 months alone, this is a pretty crazy statistic. Don't try this at home. We've spent, in terms of the federal government, 1.6 trillion more than we've taken in. So a lot of money pouring into the economy from the federal government. There's no precedent for this in an expansion, right? We're not in a recession yet, and we're doing this huge deficit spending. So will that prevent it or that delay it? Maybe. The other point I would make is 13 months in the stock market is an eternity, right? A lot can
Right.
happen between now and 13 months from now. So to suggest that the stock market has to peak right now, historically, like that would be the case. Let's say it usually peaks a little bit in advance of a recession. But if the recession doesn't start till 13 months from now, who knows? The stock market could keep running for longer. So in terms of the stock market, I wouldn't say this is a reason to sell for sure. But in terms of the economy, for me, it's pretty hard to ignore these data points when you combine it with the unemployment rate. But as you said, how long is the recession going to be? How deep is it going to be? Is it going to be big in terms of employment, right, which is what most people care about? And is it going to be associated with a broader financial crisis? All of that, hopefully not. All of that we don't know and remains to be seen. But to say completely throw this out, I think would be a mistake. What I want to do here is I want to end, though, Peter, with the signal or noise rewind. 60/40 might be dead. You and I talked about this last October. And what I said at the time, and you said as well, it's pretty interesting we're getting this headline because from a bond market perspective back then, we had yields bumping up around 5%. 10-year now is 360, so way down. From bond market's perspective, it was the best time in a long time to be a 60/40 investor. And what has the 60/40 US portfolio done since that headline?
Yeah.
28%, making us look pretty good here. So once again, the headline indicator has worked wonders for investors. Whenever anyone says something is dead, usually, and it's usually at the near the end of a bad cycle for that asset class.
Yeah, a perfect time. I can't believe that was a year ago because I remember very vividly the discussion around how it had never been better to be a bond investor in the previous decade. So, not surprising to see the bond part of the portfolio deliver, and of course, stocks roared over that period too.
Absolutely. So throw those short-term predictions out, and just when you think something is dead, it hasn't worked for a long time, it probably means it's more opportunity there. Okay, Peter, covered a lot of ground. Thanks everyone for joining us on Signal or Noise. If you're watching this on YouTube, take a moment, hit that subscribe button, hit that like button, leave a comment. I read all of the comments, try to respond to as many as possible, and I'll see you next time on Signal or Noise.